The first element of accounting are assets. We have a very formal definition for an asset, which is a resource controlled by the entity as a result of a past event or a transaction from which future economic benefits are expected to flow to the entity. So you're expected to know the full definition and, more importantly, be able to apply this to a particular event in our SACs and on the exam. So let's take each of these parts of the definition one by one. So looking at resources controlled by the entity, the resource has to be under the control of the firm. The firm must be able to decide how and when it is used and not someone else. So this rules out things that we've leased or borrowed or hired. So to give an example, Jack owns a small business and his brother has lent him the use of his delivery van to use in the business valued at $50,000. Is this an asset for Jack's business? Well, clearly not. The business does not have an asset because Jack or the business does not control it. The van belongs to his brother. In terms of what does he control, well, he can make decisions about the van that Jack and the business can't, e.g. to sell it, to put new tyres on it and so on. So this principle would rule out anything that's leased or hired as well. So if you leased a set of laptops from a provider for your business, they can't be listed in your balance sheet as assets. The second part was it must be something arising from a past event. The asset must come about because of a transaction that the business engaged in the past. So for example, we have our business on the left and another party on the right. In this case, let's say we did buy a van. Another party provided us with a van. We provided them with money. Well, that's your past event, some sort of transaction. Now, obviously, money doesn't have to be exchanged. It could be a promise of money, which will create a creditor, but that is still a transaction, which is the second part of an asset. And the last part is it must provide future economic benefits. So in this case, we want some sort of economic gain for the firm and there's some sort of benefit that we haven't received yet. The most common example of a future economic benefit is cash. So for example, we have a debtor who owes us $1,000. What that means is at some point in the future, that debtor will pay us money, so therefore the future economic benefit is cash. Cash is obviously the most common example of a future economic benefit. However, it's not the only example. Using this example, let's say we have a delivery van valued at $30,000. The future economic benefit is not going to be cash itself. The benefit is actually going to be the ability to make deliveries and drive the van. That'll help us earn revenue, but the actual future economic benefit itself is being able to use the van. So it's not cash on its own. Another example could be we prepay our insurance for $1,200 for the next year. What is our future economic benefit? Again, it's not cash. The insurance company isn't going to pay us money in the future if we don't claim anything. It's just the economic benefit. In this case, is the ability to be protected. So we're safe. We have coverage if the worst should happen. There's a fire or a storm and all our property is damaged or our vehicles are damaged, well, we're covered. So the future economic benefit is insurance protection. Looking at a big business, some of the more common assets are cash, stock, land and buildings, plant and equipment, computers, fixtures and fittings, computer software, and goodwill. We don't deal with goodwill in Year 12 accounting, but most of those other assets there for David Jones will be assets that we are required to account for during our course.